Hello everybody and welcome back to this series, Understanding How to Trade Smart Money Concepts. So this is going to be episode 2, where we lead on from the last episode, where we basically laid down the foundations of what structural laws are and the major ones we need to know. So just quickly recapping on that, if you remember, we have certain market phases, those market phases representing an uptrend, a downtrend, or a period of consolidation. Understanding that a market cycle represents one uptrend, period of consolidation, one downtrend, period of consolidation. Or that could be on the flip side. We could have a downtrend, consolidation, uptrend, consolidation. Just understanding that those four phases together, so two periods of consolidation, an uptrend and a downtrend, represent one market cycle. And within an overall trend, we see many cycles within that. So for example, what we see on screen here is a snippet of the Euro US dollar market on the 1 month time frame, meaning that every single candle is representing 1 month. We see that we obviously have some form of structure in this region. Now, how can we identify what that structure is? Well, we need to identify, are we having lower highs and lower lows, or higher highs and higher lows? So if we identify the major swing points, which we can do with a brush tool, we have a market high, a market low, market high, market low, market high, and then we see that we wouldn't take this as a proper structural low, because this is not the move that came to break the previous low, and therefore this entire move in itself acts as a singular impulse. We then have the move higher, and then again this would act as one single move lower. So let's look at these major swing points or structural swing points that we have identified. We see that the highs are being created, and they're being created lower than the previous high in the market. Therefore we are having lower highs. The lows that we are identifying in the market are lower than the previous low created. Therefore we have lower lows. We know that when we are seeing lower highs and lower lows, that structure is bearish. So we know the structure here, it is a downtrend. It is bearish structure. So currently we are within an overall downtrend. But if you remember correctly, when I was referencing the fractal nature of the markets, we understand that there is constantly trends within trends. So although this overall move represents a single downtrend, we can also see that inside of this, for example, we have an uptrend, period of consolidation, a downtrend, period of consolidation, uptrend, period of consolidation, and a downtrend. So inside of one singular phase, in this case that phase being a downtrend or bearish structure, we understand that nothing is ever a straight line from A to B. We constantly have structure upon structure being created. So in this singular downtrend, we have multiple market cycles. You see this alone, uptrend consolidation, downtrend consolidation. This region alone represents one market cycle within this overall market phase of the downtrend. So that's just remembering the fractal nature of the markets. But now, why have we learnt these structural laws? What do these structural laws mean in terms of the words I was using, creating a bias and creating a story in the market? So what that's going to include is something called a top-down analysis. Now, this is extremely important and something that I believe pretty much all traders do to some extent. The exact parameters within which they perform their own top-down may be different, but you'll see that a lot of people nonetheless are implementing this top-down analysis in order to understand which side of the market they are on. It is pretty much like being given a book. If we were to not do a top-down, we are not reading that entire book before we try and summarize what that book means. Now, in order for us to fully understand the purpose of that book, we have to read every single page. We have to go from start to finish. So in this case, we have to go from the highest time frames to the very lowest time frames to understand what is happening and gather in all of the data possible so that we can make an educated decision on what that market is going to do. If we were to simply stick to one time frame, like I said, that is like us simply reading one chapter or one page out of an entire book and trying to comprehend what the overall message or overall story of that book was. So we need to completely avoid sticking to one or a couple of time frames and start integrating a top-down analysis. Now, the reason why we have to understand structural laws, as you will see through the top-down analysis, is that helps us to establish something called our bias. Our bias being what we believe price will do, using the information that has been given and trying to predict the most probable next move. So, going back to what we were saying, we can identify the bearish structure in this. So we have an impulse, correctional wave, impulsive wave, correctional wave. Now remember what I said about this move. This is not impulse, correction, impulse. This entire move down represents one entire impulsive wave. That is because this move here did not come to break the previous low. In order for the move lower in downtrend to be an impulsive wave, it has to break the previous low, therefore creating a new lower low. In this case, that singular move did not do that, which means this overall bit of structure here is the impulsive wave because it took that entire move to break the previous low. Same again here, where we then have the correctional wave. We cannot take this as the impulsive wave because it does not come to break the previous swing low in the market. Therefore, that entire move itself is the singular impulsive wave. So, what we do here, and this is something that we take from the 3-box strategy, which is something we'll actually touch on in detail at the end, but the main thing is understanding where our parameters are. So as of right now, we know that this should be a protected high in order for us to continue bearishness. Protected high. And we understand that we have recently exceeded our target for price. Okay, so within a top-down analysis, this is the highest time frame I'm starting on. So the 1 month time frame here is going to be the highest time frame I will use. Now what we do is we identify the overall trend, which we have just identified is bearish. We then look inside of that trend and find the most recent cycle within that trend. So we understand that this is the most recent cycle where we've had uptrend, consolidation, and we are now in the downtrend. So what we can see here is that in order for us to have continued bearish, we knew that price needed to exceed this low. So let's say at this point here, let's say price was trading at this level, okay? Now what we're understanding is that once we've made this move and started to reverse lower, we could have made the assumption that this would have been a protected high. Of course, we don't have full confirmation that this high is protected until the low is broken. So technically, if we use the law itself, this should be the protected high because when that low was broken, this instantly becomes protected. We have this move down, we create this swing high, but until the previous low is broken, we cannot guarantee that this high is protected. What we can do, however, is rather than using the law in plain, simple black and white, we can say, right, well, we've seen that price has made this move higher. We see rejection from that region, and we see that price is not really wanting to go any higher, evident by the fact that we've had this ranging period. And once we see price starting to pull down, we can make an early assumption that this high should be protected. And obviously we know eventually we want this low to get broken in order to create a new lower low in order for that downtrend to continue. Now, as we know, it's much more likely for a trend to continue than it is to be invalidated. For example, we can see here, if we take how many cycles there is, so impulse correction, that's 1. Impulse correction, that's 2. Impulse correction, that's 3. And we are currently within the 4th cycle of this downtrend. That means that so far, 3 out of 3 times price has continued the trend rather than disregarded it. Now, obviously, that is an extremely small sample size, so I'm not going to say that the probabilities we can use from that are going to be a good gauge. But if you were to go back and look at every single market cycle that we have had in the market, we could have millions, billions, trillions. And if we were to find the probability of price following the trend and disregarding the trend, we know that I would say ballpark figure 80 to 90% of the time, price is going to continue the current trend than it is to invalidate it. We see so far, 3 out of 3 cycles have continued the trend. So far we have a 100% success rate with that. So we are going to make the assumption that price is going to do the same here. Now, the reason that we need this probability in our favor is because let's say we got involved in a sell position at each one of these regions, 3 out of 3 times we would be profitable because 3 out of 3 times price has exceeded the previous low, therefore creating the new lower low. But anyway, without getting too sidetracked, let's return back to what I was calling the top-down analysis. So what we're doing is we're working down the time frames to understand the parameters. So as of right now, we understand that we have recently now created this impulsive wave that has come to exceed the previous target in the market. And we can now expect that at any point from now, because we've already exceeded that and created the new lower low, at any point moving forward, price could very easily create a correctional wave that comes back up. We know that correction wave should, or is most likely to protect that high. Therefore, we know that when price trades back up, it's going to reverse somewhere below that high before then making another move lower to surpass this market low. Now, within this top-down analysis, obviously we can tell that from this time frame, if you bear with me one moment, so this is our new target because eventually this low is going to get broken, and this is simply a liquidation of the low. We can now remove this because after the liquidation, this high definitely is protected, and this is our target. Now, of course, if we were to stay on this time frame, we would be waiting a very long time for this correctional wave to get delivered. We're on a monthly time frame. We see that on average, correctional waves, I mean, this one alone, we're potentially looking at 10 to 12 candles. That is 10 to 12 months. We would be waiting potentially for this correctional wave to be formed, and therefore we would be waiting 12 months for us to potentially find an entry in the market. So what we need to do is continue going lower whilst understanding the parameters that have been set. So now that we're on this highest time frame, now we're on the first page or the first chapter of this book, we have laid the foundation for what price is doing longer term. So now that as we go lower, we have that backstory in our minds. So let's do that. Let's go lower. And we can see that this alone, even though we said that on the monthly time frame, this entire thing as itself represented a single impulse, but that's when we're looking at the entire structure on the screen. If we were to focus now solely on this region, we see that we have had an uptrend, consolidation, downtrend, consolidation, uptrend, consolidation, downtrend. So technically, the current phase that we are working within is this downtrend. So we can see that within this downtrend, we have many impulses and corrections or market cycles. You see, we have impulse, correction, impulse, correction, impulse, correction, impulse, correction, impulse, correction, impulse, correction, so on and so forth, all the way down to this region. Now, what we want to do now is after we've identified the lower time frame trend, which we understand we're working within, this is a trend, which we can even highlight with a box. So this is the trend we're working in, which is a downtrend. So we'll have that in red. We would now look inside of the most recent part of that trend in itself. So the most recent cycle where we understand we've had consolidation, downtrend, consolidation. We're now working within an uptrend. So this alone is one market cycle within the overall downtrend that we have identified. So what we can say, and we'll even go to a lower time frame to see this more clearly, is we know that this is a swing high, and this down here is our swing low that we identified prior. Now what we understand is that after this previous lower low in the market was liquidated, which is a term we'll get onto later on in these videos. After that low was broken, this becomes a protected high. Now at this point, we understand that this low here is still our target, because we know that in order for price to continue the downtrend we have identified and to continue this single cycle we have identified, we want a new lower low in the market. So what we can expect is that price is going to trade down through that level to exceed that low to continue the trend, because we know price is more likely to continue the trend than it is to go against it. But what we can now do and understand, well, how would we actually understand when to get involved in a position? Because of course we want to get involved at the start or as close to the start of an impulsive wave as possible. That being said, it's because we always want to trade with the trend if we can. Terms that you may have heard before, the trend is your friend. I know me or Luke has probably said that many times before on the channel, but it's definitely a good thing to remember, a good phrase, the trend is your friend. We always want to be involved in the direction of the current prevailing trend in the market. We know that we have identified a downtrend, so we want to be involved in downwards positions, so sell positions. And the best possible place we could get involved in a sell position is as close to the start as an impulsive wave as possible, because that is where we have the most leg room to profit. But then it's understanding, well, how do we get involved in a sell position here? Because we don't know that it is an impulsive wave until the low has been broken. By that time, we've already missed the potential trade because the move has already happened. So how can we understand when the market is reversing so that we can get involved in a position? And that's exactly why we need a top down, or we need to use timeframes and our structural laws on a range of timeframes. So let's look inside of this. We would have known that if we go slightly lower, just to help me make this point. Okay. So inside of this singular cycle we identified, where I said we had consolidation, downtrend, consolidation, and then we're working within the uptrend, okay? Now that uptrend we know has to protect this high and then should reverse anywhere below this high before making the next move lower. Well, for starters, how do we know when the correctional wave is a correctional wave? Well, that's because we know on a lower time frame, this move in itself is acting as a downtrend. Within that downtrend, we have many different cycles. If we go low enough to be able to see the cycles, we can see we have impulse, correction, impulse, correction, impulse, correction, impulse. So technically, in terms of this structure, which has been identified on what we're on, the 4-hour structure, we can see that that high should have been protected if we wanted this trend to continue. So the 4-hour trend. If we wanted the 4-hour trend to continue, we know that high should have been protected in order for this bearishness to continue. Once that high is broken, we understand that bullishness must be emerging. But because we've done our higher time frame analysis, we understand that that break of structure is actually just to deliver a correctional wave in the scheme of this as a singular cycle itself, as a single impulse, and this being its correctional wave pair. So that is how we use the lower time frames to understand what's happening, because as we went lower, we understood that this break of that swing point there represented a break of structure to the upside. Now, when we see that break of structure to the upside, we can't just assume, right, there's an uptrend, but we don't know how long for. No, we zoom out and we say, well, why is there an uptrend? Well, we know that's because we are looking within higher time frame structure of this in itself on the 1 week time frame as a 1 week downtrend, and this being a singular cycle within that 1 week downtrend. So then now, how do we understand when this correctional wave is coming to an end? Well, we do the same thing we did here to identify when the correctional wave was forming. So we'd potentially go to a lower time frame in here and look inside of that. Well, where are our main swing points? Our bullishness on this time frame would say impulse, correction, impulse. So technically on this time frame alone, this is the protected low of bullishness. So we understand that if we use a green box here, the bullishness inside of here that is creating a higher time frame correctional wave is valid until the protected low is broken, because we know that structure is valid until the protected low or the protected high is broken. So seeing this protected low broken is when we would then know that it's no longer a correctional wave, but then instead an impulsive wave. But by the time, again, as we said before, that price actually exceeds this level, it's potentially too late to be getting involved in the trade. Well, why? Because price has already made it half, if not more, of that impulsive wave already. So what we need to do is we need to go even lower. So here we're on the 2 hour, and this is 2 hour bullishness. We would go potentially to a 15-minute time frame and say that we can see that this move here represents where, even though we saw this as impulse, correction, impulse, we know that a impulse higher in itself on a lower time frame is an entire uptrend. So we see that we have structural points within this: impulse, correction, impulse, correction. I'd say that that entire move higher is an impulse, correction, impulse, correction, impulse. So in terms of 15-minute structure, this should have been a protected low, and therefore the break of that protected low is technically a break of structure to the downside and an early sign that this structure is coming to an end. Now we have to remember that because we have a 15-minute break here, let's put that as 15MBOS. What's technically happening here, and this is why we'd be preemptively assuming that this 15-minute break of structure is sustaining the new impulsive wave in terms of this market cycle, because of the fact that we know price could still remain bullish with this as a impulse, correction, impulse. This could simply be another correction before the next impulsive wave higher. So we would be making a preemptive decision that this 15-minute break of structure is sustaining the target being met, because we don't know that until we have this protected low being broken. But that is where we implement risk management and safety measures. So we could assume that this 15-minute break of structure represents the fact that we are now starting a new downtrend. So we could get involved in a position straight after that happens, stop loss above that high, take profit, of course, all the way down at that target. And you see here we have a 4.4 RR trade just using structure without the implementations of step 2 and 3, which we haven't even got to yet. We've already got a 4.4 RR position. Now what we would do though, however, is understand that price, as we said, quite easily, this could be a correctional wave within bullishness. So it could technically reverse anywhere above this protected low, which is where we have to implement risk management and safety measures, which is another video in itself. But understanding structure, we know that, okay, this 15-minute break of structure could potentially mean that we have the move lower all the way down to here. In the same way that when we saw this bullishness here, impulse, correction, impulse, correction, impulse, we could have technically argued that once this low was broken, which should have been protected, we could have got involved in a position to trade price down to that low. But we see this would not be favorable. That's where we're going to introduce another bit of information. And that is saying that in terms of this, in terms of what's happening here, a correctional wave almost always will come back up to exceed 50% of the impulsive wave. So we see impulse correction. What we can do is we get the Fibonacci and we take the start of the impulse to the end of the impulse. We have something called a premium and a discount. The upper 50% being the premium, the lower 50% being our discount. Now, if we want to get involved in sell positions, we can say that a sell position is only valid if the execution of that sell position happens in the upper 50%, therefore within the premium. We see that the entry here would not be within that premium, it would be within a discount. But we see the entry up here would be within the premium and not within a discount. So therefore, that's what we can use as our validation within structure that an entry there is valid. Because we know if we get in below the 50%, our risk to reward ratio is going to be extremely low, and the likelihood of that trade playing out is going to be lower in itself. So doing this, using the Fibonacci tool to identify the most recent impulsive wave and getting involved in sell positions when we are within the upper 50% or the premium. So that is exactly there how we would have used structural laws to execute a position. then what we can do is we can do this an infinite number of times. We can go down even lower, constantly and constantly, understanding that now we've had the 15-minute break of structure. This in itself is now a downtrend where we've got clear bearish structure, impulse correction, so on and so forth, all the way down. And therefore we could do something similar where we identify the most recent impulsive wave, which would act as this. We understand that a single impulsive wave lower also represents a downtrend in itself. So we could go lower to represent that downtrend where we've had impulse, correction, impulse. We could say that once price starts breaking to the upside, that is our correction wave. We could then say, all right, well, if price gets to the premium, which it would need to be in the upper 50%, so anywhere above this line, and what we would see potentially is as price starts coming up, we see that within this in itself, we have impulse, correction, impulse, but we understand again an impulsive wave down represents an entire downtrend on the lower time frames. So we could therefore identify the most recent move lower, which would be that. So that high should have been protected to continue this downtrend in itself. Once we see price break that, we understand that we are having an uptrend or a correctional wave formed. If we were to then see price trade into the premium and then see a break of structure, we could get involved in a position there. Stop loss above that high. Take profit down here, yes. But what we could say is, well, yes, price should exceed this level, but we know that from our higher time frame analysis and our bias, that longer term price should also be exceeding this level all the way down here. We can preemptively assume that and infinitely increase our RR, because where it was once 4.4 R, we're now looking at 20 RR. So we have times that, a multiplication factor of 5 there. So we'd get 5 times more returns from that position. And arguably what we can do here is continue going down an infinite number of times to refine that stop loss, because each time we go to a lower time frame and identify a different trend or a different cycle in the market, we can also then refine that stop loss because we are working within more fractal structure. But because of our higher time frame analysis, we understand that longer term price should still be reaching the level all the way down here. Now this should all make way more sense as we reach sort of episode 7 and 8, where we introduce the 3-box strategy and the proper analysis technique and how we fully implement a top-down analysis. But understanding that what we've done here is, as we've gone lower, we keep adding to the story. We keep adding a new page to the book, where we started off on the higher time frame, identifying the fact that we are currently bearish longer term in a downtrend. This is the most recent move within that downtrend. As we go lower, we represent the fact that this is a singular impulsive wave and therefore a singular downtrend in itself. We can go lower and find the most recent cycle within this overall downtrend. This being the most recent cycle, we understand that within this cycle we've had downtrend, consolidation, uptrend being formed. We understand that within that uptrend we're trying to find confirmation that the new impulsive wave is being formed. We have found early confirmation through a 15-minute break to the downside, where we could be looking for potential entry positions. If we wanted to find a better and more refined entry, we'd then go lower again to look into more recent fractal structure. And then that's where we've seen again, we could see something similar, correctional wave formed. We see on an even lower time frame, like the 1 minute there, that we have a break to the downside and we can preemptively get involved in position. So that is the importance of using timeframes in order to create a story, in order to add more pages, more chapters to that book, to understand what price is doing longer term and give yourself more information of what price is doing. Now, I didn't want to drag this video out too long, so I have therefore tried to quickly run through, with still providing as much depth and information as possible, the implications that structural laws have within the market and how we use that to create a bias and a story, where we can understand how we can take positions on a daily basis using what the higher time frame tells us to profit more. Because had we not known that our overall target was here, the example we were showing before on like the 15-minute time frame, where if you remember correctly, we could have got involved in a sell there, we'd simply have that take profit here, where that's only a 1.8 RR. Because if we were to simply work on this time frame alone, our only expectation is for price to reach this level. But because we've done a higher time frame analysis or a top-down analysis, we know that longer term price should exceed that level. So instead, we could take a partial close, so close maybe 50% of the position, and then leave 50% remaining because we understand that price could work within our higher time frame bias at this point. Okay, so I just wanted to add a little snippet actually just onto the end of this video before I actually round things up, because when I filmed the main portion of this video, it was very late and there was slightly something that I didn't pinpoint correctly or in enough light for you to understand. So when I'm talking about doing this top-down analysis and understanding the bias, there's quite a simple way we can actually go about this. So we'd start on the higher time frames and identify the most recent trend. So starting on the highest time frame here, the 1 month, we can identify the fact that we have this overall downtrend. What we do is we look inside of that overall trend and find the most recent cycle or the most recent impulsive wave. So what I'd be doing is I'd be looking inside of it and saying, right, following the structure, I understand that this is the most recent impulsive wave. I would identify that with the 1M. Well, actually, we need to change that to the impulsive wave box. This will all be explained more in depth, as I've stated, towards the end of this series when we go into the 3-box strategy, or if you'd like a slight insight, there is a couple videos on the channel that go over the 3-box strategy. If you search that in, you will see. So once we've done that, we've identified the most recent impulsive wave. We then go lower again. We find the trend within that impulsive wave that we've just identified. So we understand that this is an overall downtrend. We then look inside of that overall downtrend to identify the most recent cycle or most recent impulsive wave inside of that. Therefore, we would do so on this move. Obviously, we'll need to go lower here just to gain more information on that. Okay, so yeah, perfect. That is our most recent impulsive wave. That is, let's say, on the 1 day. We now understand, if we go lower again to look inside of this, the most recent trend that we can see is this bullishness, but because we know our overall bias is bearish, because the higher time frames indicate that we are within a bearish impulsive wave, we know that we want to get involved in sell positions. So we can identify the fact that we have this uptrend here, which we know this uptrend has the purpose of being a correctional wave. And as I said, we want to identify impulsive waves, not correction. So this is an overall correctional wave, which has the purpose of coming up somewhere within this impulse to reverse before making that new impulsive wave. Remember, we talked about the premium and discount. So we understand prices within the upper 50% or the premium. So it's likely to be reversing at this point now because we believe there's not much more room now for the correctional wave to trade higher. Therefore, we can assume on the lower time frames that the breaks lower are representing the creation of the impulsive wave, and that is a preemptive decision that we can make. So we understand that within this, we had the break of structure of that level just here, which meant that this is the emerging bearishness or the new trend starting. So we understand that this now is representing a downtrend, which is the side of the market we want to be on. We can do the same thing where we then go to identify the most recent impulsive wave within this trend, which we know would be this right here. That has been identified on the 1 hour. We can then go lower again, look inside of this, look for that premium, which we understand would be in this top 50%. We see that price has just tapped into that premium, so we could be looking or start looking for sell positions. Now, in order for us to confirm the creation of the new impulsive wave, because we understand this bullishness is representing the correctional wave, we'd be looking inside the bullishness and saying, as of right now, this is a protected low. Therefore, once we see that protected low broken, that is a sign that the new impulse is forming. Therefore, we can get involved in a position just there, stop loss above. And then, as we were saying, our overall take profit could be at the target all the way lower of our monthly structure, therefore giving us a much larger position. Now, what we would be doing is, as I stated, implementing safety measures throughout, partials, stop losses, stop loss trailed or stop loss to break even, to ensure that we are safe throughout this entire move, because we are making quite a broad assumption that this move will sustain the overall target here. But what we have been allowed to do during this top down is understand what price wants to do longer term, therefore be involved in longer term positions, but use the shorter time frames or the shorter term time frames to find the refined entries. So as price continues to trade lower, as we create a new impulsive wave down and then a new correctional wave, we constantly have opportunities within the creation of each impulsive wave to get involved in positions. So we could technically get involved in multiple positions in order to try and ride this entire move down. You know, again, as I said, we can do this an infinite number of times. So we've just done this here on the 1 hour. We could then go, for example, to the 5 minute or even lower to the 1 minute. Say that what's happened here is we've had impulse, correction, impulse, okay, because we know that the high's been liquidated there. So we've actually technically seen a break of structure of what should have been a protected low of bullishness. Therefore, we can take this as the first impulsive wave of emerging bearishness, which has been identified on the 1 minute. And we can say, right, well, we're delivering a correctional wave. We could then go down to like the 15-second and say, right, well, are we within the premium? Yes, we are. So if we now see a break of that low, we could preemptively assume that the break of that low is sustaining the entire move lower. And this is where we're able to get a stop loss of 7 pips there. And we could potentially assume that that sustains the entire move lower to the target all the way down here, which has now given us a 52 RR return. Okay, so what we are allowing ourselves to do by using a range of timeframes is refine our entry, gain more entries, therefore profiting more from the same moves. Now, as I stated, because we're on such a lower time frame, it's very hard for us to say there's a high percentage chance that the break here would mean the overall target hit some few hundred pips away. So we would be taking safety measures along the way, partials, all of those different implementations. But on the off chance that price does eventually run to that 52 RR point. So hopefully that clears up what a top-down analysis is, why we can benefit massively from completing one. And as I stated, if you want a bit more information on that, check out the 3-box strategy video on the channel, and it should walk through that in a whole lot more depth. So hopefully that all makes sense. Hopefully now you understand why those structural laws are important and how we implement them within our analysis and within market structure as a whole. But that is pretty much going to tie up the very first section. So step 1, market structure, that is what episode 1 and 2 have been focused on. But as we now rear into episodes 3 and 4, that's where we're going to dive into how we use structure to refine entries in the market in order, as we say, when these correction waves are forming, we can identify where in the market holds relevance or is a point of interest to pinpoint the exact point that a correction wave should reverse before the impulsive wave starts forming. In that case, we can actually refine our entries, find better entries, and understand and add more pages to that book of the story and of the bias. So hopefully you've enjoyed this one. If so, make sure to leave some feedback. Let us know if you're excited for these next parts as we move into step 2 of the 3-step approach to the smart money concept strategy to the market.